Okay, I think that perhaps we can start. Good morning, everyone. My name is Maria Victoria, and I work at the Italy America Chamber of Commerce. Today, we're here with Bill from WDA Strategic Brand Marketing, and we're gonna listen to the fourth edition of this webinar. Today's topic is stakeholder capitalism, and I'll leave the floor to Bill. Please, if you have any questions, just type them in the chat or keep them for the end where we have a little Q&A.
Thank you, Maria. Hello, everyone. Can you see the screen? That's the first question.
Yes, they can see.
Okay, but they don't see me for some reason. Yes?
No, they do see you.
Oh, okay, good, very good. Because I do want to make sure they know that I'm real. I'm here. Okay. Hello, everyone. Some of you. Look. Yes, wonderful. Wonderful. Old friends. Yes, colleagues. Fantastic, and thank you for joining me. All right, so knowing that you're all here makes me feel, of course, more energized. And we're going to take a look today at this concept of stakeholder capitalism, obviously a conversion of the classical stockholder capitalism. And it is the almost the call letter phrasing of a new vision that we can have capitalism, as I say, still capitalism, but with a slightly different shade of green. And you can see the play on words a little there, classic stuff, but good. All right, so what do we want to look at today? Well, the capital we need to go about this this climate change challenge is huge. It's estimated to be somewhere between $6 to $7 trillion over the next 10 years each year. And the question is, how do we get this money and where do we get it from and what are the challenges in raising the capital? The second is, if we get the money, what do we do with it? Green bonds, social bonds, are these really opportunities or are they marketing plays? And as an ordinary consumer or as a business person, can you in some way commit yourself and get involved in these kinds of investing opportunities? Because they are a redefinition of value. The next part of the seminar is going to be a chat about what's called materiality assessments. As you probably know, in accounting and in attorney definitions, the question of what is material evidence or what is material data is really important. And that's become a central feature, in fact, in social and environmental governance. The regulatory commissions, as well as legislatures, have made it obligatory that businesses now go about the process of evaluating their position in the sustainability space and what commitments they've made, and then publicizing those to the marketplace and to their clientele. This is especially compelling in the financial sector, where you have real responsibilities based on a fiduciary relationship to people who have invested in stocks and bonds and other assets recommended by equity houses, such as BlackRock, for example. So the question is, what degree of data and what specificities do they have to gather and present to their investment community to meet the proper standards that are now out there. And in the final part of it, we're going to take a look at what's happened. There's been pushbacks on ESG, on social responsibility, DEI, the whole idea of diversity in businesses and in operations. We want to take a look at why and how important these assets are to the sustainability and climate change effort. One, for example, is we don't hear the word ESG much anymore. The call letters have fallen off and sustainability has become a kind of umbrella term. And that's a serious omission because it enables people then to define words as they see fit, when they see fit. And that creates enormous market confusion. And we're seeing a lot of that. Remember, we don't have a Webster's Dictionary of Sustainability, but Lord knows we could use one. So the more we begin to homogenize the concepts, the less specificity we have and focus we have. And that creates very, very difficult problems in terms of unifying the efforts towards solution. All right, so let's begin with the first challenge that I see, and that is, are we focused on the right sources and demographics? After the Glasgow summit, one CEO said that we're on the right pathway. We now need to accelerate. We need to intensify. And another pointed out that there's a shortage of money. We need to meet these incredible technological and very often challenging new ways of meeting this previously unknown and ways in which we weren't prepared at all to meet as a society. So one of the things we found is that we have to look beyond the profit motive, because the money has to be raised and raised in a way where the money is. And we're going to find that this is a challenge in and of itself, because the tendency is to look at sources that are not necessarily capable of funding this kind of challenge. So we want to talk about going beyond profit. And we have to begin to think about who is in a position in the societies that have these resources to move beyond the profit motive, because we're looking for something bigger, something more lasting to drive these kinds of changes. So who's and where do we find this? Well, if you look at the boomers and you look at the older segments, we have to look at the kind of social values and the legacy motive that can get these kinds of individuals into the center of the thinking and the investing that's needed. And again, massive amounts of capital are needed. As I said at the beginning, you're talking of 70, 80 trillion dollars over the next 10 years. But when you think about the boomers, one of the things you tend to think about, as well as generations after the boomers, that these are the people who were in the civil rights movement, Woodstock and things. They have been involved in big social protest movements. And in a certain sense, the climate challenge is a social movement with the same kinds of intensities and the same kinds, if you will, of serious outcomes if they're not met properly. So these cohorts tend to have both the capital and the experience and the commitment. And they're at a stage now where one of the things that you want to do is you want to leave behind something bigger and greater than what you found when you got here, the legacy motive. And I think that's the way we have to begin to rethink our marketing. The scare tactics simply don't work, very counterproductive. The data concepts very often become overwhelming and confusing. The technological ones even more so. But if you begin to think about legacy, what do you want to leave behind that's better than what it was when you got here? I think it's a powerful driver. And our marketing people have to begin to move, I think, and rethink some of the venues and some of the concepts that are driving the marketing efforts. So let me take a look at this, if I might, in terms of what I call moving the needle. Okay, as I said to you, but let's go a little further down the road here and see what we can find in this regard. Well, here are some of the instruments that can be used to get this particular cohort or those cohorts involved in how we go about the process of raising the money. Impact investing, basically to measure the social impact, the environmental impact on the challenges we're meeting in this space. And finance houses and banks have created a variety of bonds that are focused on the particular challenge. So, for example, green bonds, renewable energy investment, cleaning up, if you will, landfill sites and things of that nature would very often be funded and supported through green bonds. Social bonds could, for example, be used to change communities, to build affordable housing, healthcare access, and what have you. Blue bonds are focused, as you might realize, of course, from the reference, to marine conservation, clean water, sustain fisheries, save the whales, things of that nature. And then green fares. You may have noticed the airlines, if you've flown over the last few years, saying whether you want to contribute a percentage to their attempts at using more sustainable fuels. Now, in all these instances, these are fundamentally investment instruments that are they're competitive. They're not, but they also have with them the responsibility that the issuer of the bonds has to have a plan on paper. And that plan then has to be monitored. And there has to be, in a sense, what I call environmental key performance indicators. In all instances, you should have access to those if you're an investor, and basically make sure that those are met, because your bonds are payable if the actual project it comes to pass. So the investment, just like all investments, is a risk. But then again, it's a risk with a return that goes beyond profit. It's the legacy return that I've referenced earlier. All right, so one of the ways in which you can make yourself an even more informed consumer is to look at the International Capital Market Association's principles, because that'll tell you whether the bond is, and the principles are beyond green here, by the way. They apply to social and to blue bonds and what have you. It gives you a way that you can become better informed, and it indicates what the legal and fiduciary expectations and standards are. And that will tell you whether the bond is a true bond and whether the investment has, if you will, some credibility. So I suggest you take a look at this. Obviously, I have it as a hyperlink, but I can't do it in the time we have, but you certainly can, because you'll have this deck, by the way, at the end of the presentation. So that's a good source for standards, and we're going to give you a few more of those as we go along. All right, so where's the money going to come from, and where's the problems going to remain? Well, as we're saying, one of the things that we see is that the nature of government, although they have the financial resources given the fact they can tax, they really don't have, if you will, the cultures or the operational capabilities. First of all, governments move very, very slowly. Secondly, when they're in international forums especially, there's constant compromise, which means really aggressive kinds of solutions get awarded down. So for example, in Glasgow, there was a phrase in the final document that all 196 country participants were going to sign, which spoke about phasing out coal-fired plants. And the language was changed to phase down. So that means the coal-fired plants could continue, but would gradually over time be replaced. But that couldn't just continue to intensify the program, because the fact that there's mitigation, which is what phase down is, isn't elimination. And if we don't do both at the same time, we may become overwhelmed by the challenge of climate change. And that's the big difference. It can't be simply mitigation. There has to be elimination of the CO2 and the other kinds of gases that are continuing to violate nature's bounty and balance. The other part that happened at Glasgow, there was an omission of mentioning fossil fuels themselves. There was just coal, but what about oil? What about natural gas? All of those things were not involved in the final document. But here's where the private sector and the investment kinds of instruments we are talking about can come in and begin to talk about a prosperity purpose. So if you look at a company such as BlackRock, and there are others, and we're not here to promote BlackRock per se as a financial investment house, although they're quite sound, but there are others as well. And what they did was pretty amazing. And let's take a look at how they approach the challenge. Sustainability should be our new standard of investing. What a powerful, powerful phrase. This is actually on their website, and it's in the documents that were sent out to their clientele. What they realized is that the investment houses have to come up with a new language. Again, as I said at the beginning, there's no sustainability dictionary, and we do need one. We need to know what words mean, because you can't be a meaningful investor, a responsible, if you will, citizen, if the words have vague concepts and meanings attached to them. So what they've done here at BlackRock is saying we're going to create standards, and standard means a consistent language of explanation. So you can see that both Larry Fink and Barbara Novak, the co-CEOs, have made very, very specific commitments in writing. If you read Larry Fink's letter to the stockholders and shareholders, you will see, and stakeholders, may I add, you will see this commitment. And then Barbara Novak has talked about a common language for sustainable investing. So they're going to create this dictionary, and they have, in fact, done this. So the profit motive is now thought of as a prosperity purpose, broadening the sense of obligation and the massive amount of capital that's needed. This, again, is Novak's words. She's creating this new sense that you want to change the mindset. And remember that words are buckets of values. And if you continue to use the old language, you continue to think in terms of the old purpose. So this is an important transformation that all companies need to begin to think about. The third part of this is number C. Imagine the need to divest portfolios of assets that do not serve ESG objectives. And this created an absolute storm of pushbacks, which I'm going to talk about later, because the traders felt that this would mean that they would be limited in some of the instruments that they would be able to sell. This is an issue, and you've got a battle between the two cultures within these investment houses that continue, if you will, to this day. So we need to find a way to navigate this, to say the least. The other side of the coin is if you don't think about creating standards and a clear language, you run the risk of greenwashing. That is, of making promises to your investors, but you don't have the clear enough language that enables them to evaluate whether this is truly an ESG or an environmental investment, or whether it's simply a company that has some of its assets in environmental strategies. So the greenwashing, the marketing communications creates the risk that if we don't have a single language and a clear pathway, we really can't have investment approaches that are not misleading. And the informed consumer, if there is such a thing in this kind of environment where you have uncertainty of language and standards, how do they make actual informed choices? So this was done in 2020, and over the last 4 years, that is this commitment to sustainability so pronounced by BlackRock. And again, as I say, we're going to see some pushbacks. And I think this also affected the whole idea of diversity, equality initiatives. So we're going to see that later on in this presentation. All right, so to get back to the conversation we had a little bit earlier about the cohorts and the investments, who has the money and how much? Well, I'm going to take this concept and broaden out a little bit and take a more specific look at it. Wealth and money is clearly in the hands of Gen X, boomers, and the so-called silent generation. That is consumers and investors in their 50s and 80s, and of course, the bridges in between. We've indicated that these are the people who have been accustomed to, in the past, be involved in very, very broad and striking social and political movements, and have put their money in investments in that regard as well. Now, what's interesting, if you take a look at number B here, the US median age in the US is 39. It means that these cohorts represent over 50% of the US population. But more telling is that the baby boomer segment itself, and this is a staggering number, 72 million, but here, listen to this, $60 trillion in assets, over 45% of the nation's wealth, and here's the investment potential, 14.5 trillion in investable income. In other words, in fluid income that can be invested in environmental and DEI and other such sustainability efforts. So if we look at the millennial and Jay-Z, who are challenged, of course, with other issues such as family and college loans and new jobs, they don't have the assets. And this is not to say they don't have the commitment, because we're going to see later on their commitment is extremely high. But we need to go where the money is, as well as where the legacy sense is. And the feeling is it's in these older cohorts who need to be approached in marketing, not as just sort of old timers, but fundamentally as the source in terms of investment and commitment of stakeholders and solutions providers. So this is an important, I think, shift that needs to begin to take place. It's not that we forget the other generations, not at all, but we begin to integrate into a broader schema of marketing those who have the money and who have a history of commitment. Now, there's also a conversation that goes on about materiality. And I mentioned this earlier in the in the introduction. The Security and Exchange Commission in the US defined this as information that a reasonable investor would likely consider important when deciding to buy or sell securities. So this is also something that the US Supreme Court has defined. And some of the examples that companies must report on. If there's a change to the target or the maximum offering amounts in an investment, the terms of the security, what's risk or not risk? Has risk changed, for example? You can't simply now go into the investment markets without having a clear indicator of risk. And if the risk dynamic changes, you have to be proactive in securing that information and reproducing it for the investment community. C, substantial changes in the company's officers and directors have to be reported in a timely way, because that can affect the ability of the company itself to optimize its capabilities. And then substantial changes in the company's financial information. Companies, obviously, that are challenged and perhaps on the verge of bankruptcy and things, they need to be clear about that they become a risk. So the commission has the materiality rule that has been, in fact, confirmed and certified by the Supreme Court. So there's a real credibility about this. But the challenge is, what is a reasonable investor? You know, we have this idea in law about the everyday consumer. And we have a general idea over time, but we don't know what is a reasonable investor and who defines it. And in a very real sense, the courts have left that open. And that is a real challenge, because different levels of interest, education, if you will, capability, really determines whether or not you really get the investment picture, which can be quite complicated, as we all know. So that's something we have to think about and work on. Again, more back to Barbara Novak's concern, we've got to begin to define terms more specifically with more context and more content. So one of the ways in which we might be able to move this along is what is now called the double materiality. And this is something the EU has committed to in its various kinds of commission pronouncements and standards. And it's important to realize that a company is obligated to follow these, even a US company, a Japanese company, whatever the company is. That is, you don't have to be headquartered in the EU to be obligated to follow EU trading and commission regulations. If you do business there, even if you're registered in Delaware, you are obligated to follow the double materiality rule. And I'm going to go over what it is in a moment. So as you begin to develop a more involved and a drill down understanding of the specifics of materiality, and all of the regulations that the SEC or the FTC in the US might be promulgating, we really recommend very strongly that you follow the European Union, because they set the standards, and the benchmarks also are followed by the SEC and the FTC, and eventually we're going to catch up to them. So it doesn't seem to make much sense in not following the EU if eventually they're going to be perhaps the gold standard. So the double materiality is the company must specify how it impacts the environment, and society. Again, not just the environment. So you're back into issues of DEI here again. And how sustainability, risks, and opportunities affect the company financially. So what used to be in the investment community, we just have to tell, what it is that our instruments are all about. You really have to say how your company is planning its own sustainability practices. So that's the double, if you will, responsibility in the EU. The companies must publish their positions and their standards. And by the way, there's a really good source book called the GRI, which is the Global Reporting Initiative. Again, the book is, you could Google it, but this is the kind of thing you should really have on your business, in your business portfolios, because it tells you the kinds of reporting regulatory patterns and standards that are beginning to become embraced globally by businesses and by governments. So GRI, which is again the Global Reporting Initiative, and again, it gives you a sense as to what you need to begin to incorporate into how you write and publish your reports. So considerations for a double materiality assessment include which topics to disclose, which stakeholders to engage, along with identification and scoring of likely material impacts, risks, and opportunity. Scoring. Now, that begins to raise, some interesting questions. Are we going to suddenly put a number on these? That's really increasing the complexity of things. And, if you will, perhaps the confusion, because who decides which numbers and the weight of those numbers? So let's take a little more, if you will, broader look at this. Stakeholder engagement can help you create a list of the EG topics. That is, if you begin to reach out to your stakeholders, they become partners with you as a business owner, insofar as you begin to see what it is that are relevant, okay? And you get a sense as to who your stakeholders are and how intense they are. So you can have interviews, focus groups. It could also be publications outside of yourself that give you a good reading as to how your stakeholders feel about certain values and certain commitments. To identify the stakeholders, here is just some lists of categories that you should be basically getting data on, getting information about. But let's keep in mind that these could be negative or positive. And also, it's important to realize that the so-called measurement can also be qualitative as well as quantitative. And that gives us some wiggle room and some latitude. So it could be good, better, best. It could be, yes, perhaps maybes, and or no, perhaps maybe, I should say. Or it could be a 1 to 5 if you want to quantify the outcome. But you have to be clear that if you're doing that, what the meaning of those numbers and values are. Okay, so the ground rules for reporting is what I've just mentioned to you. One is the impact, the two perspective, outbound. The other is inbound, the financial part of it. And this is a much more sophisticated way to look at how companies which are claiming commitment to sustainability are actually performing. Now, this is part of the overall EU's CSRD disclosure commitment. And this is their very, very extensive and intensive commitment to the consumer sustainability directive that they have, where consumers are at the center of every standard and every regulation that the EU designs. And again, as I indicated earlier, It's much more comprehensive and much more consumer friendly than anything the SEC does here or the FTC does in the US. So I also suggest you take a look at the CSRD, the Consumer Sustainability Reporting Directive, which is fundamentally the ground rules by which the EU understands that people are meeting their responsibilities, or, if you will, whether they are involved in greenwashing and other violations. So, to get a bigger sense again, take a look at the European Sustainability Reporting Standards so we can see whether and how thresholds can be qualitative and quantitative, which I mentioned before, the measurements that go into the publication. And I know I'm saying it a couple of times, but it's really important. Study what's going on in the EU. And again, all of these references are, of course, from the EU Commission. All right, so let's begin to get a little bit into CSR and DEI and sustainability. I mean, we've been talking about corporate social responsibility through the Blackstone initiative. And what we're seeing here is, as I mentioned earlier, ESG is really suddenly not discussed as readily as it used to be. And we don't know why that's the case, except we see some signs from people who are traders and people who are stockbrokers and people who simply feel that perhaps it's more than they want to try to learn to understand. But nonetheless, there's no doubt that ESG, the environmental part of sustainability, appears more urgent and it has a planetary focus. And those are really the central part of what the UN is involved in its summits, although they also do CSR and DEI planning and they have smaller kinds of meetings. The big meetings tend to come in and around ESG. So we want to take a look at what that's all about. And I think we've done some of that in the earlier conversation. But we have to know what CSR stands for. So it's corporate social responsibility, as I've indicated. And one of the key initiatives in that is the idea of diversity, yes, and equality initiatives. The idea is, and there's data on this and some really good sound data, there's a definite correlation between corporations that embrace a variety of different types of stakeholders in terms of their own lifestyle, ethnicities, backgrounds. The correlations are very strong that corporations that embrace CSR, ESG, and DEI initiatives tend to have better balance sheets and tend to have better stock performance on the stock exchanges. So there's something to be said for these initiatives in terms, again, of the prosperity objective. It doesn't contradict it. It seems to enhance it. More recently, however, what do we see? We see Harley-Davidson, Tractor Supply Company, John Deere, very, very big corporations. All right. In response to stockholders, all right, I guess we can call them stakeholders, but at stockholder meetings, we see critics and in social media onslaughts saying that it's gone too far. There's no need to do it. It's an unnecessary expense. So we've got these two cultures that are in conflict with each other. But the data definitely supports the fact that diversity has, if you will, prosperity outcomes. Assuming, of course, the company does everything else right. But there's definitely a higher correlation. So why do we see this pushback? And I think it has something to do with the culture of what is seen as unfair practices. But it really isn't unfair practices. It's really a kind of commitment which says we want the playing field to be as equal as possible. And the outcomes which confirm that equal playing fields tend to create prosperity outcomes. So this is the triple bottom line that the stakeholder concept is all about. Now, even companies such as Ford have not closed their DEI undertakings, but they've cut back in terms of funding. So we see this response in a way that is not totally positive in terms of the support that we need. Because if we do this, we're going to leave out, in terms of the global challenges, those very, very people and those very workers who are on the bottom scale of the stakeholder, if you will, benefits. People who work in factories, people who work in mines, people who are on the lowest scale and are struggling to make ends meet. And those are very often the places where the environmental sustainability, as well as, of course, the CSR responsibility is most urgently needed. So if we leave people behind, we're going to leave climate change behind. We need to do these things in tandem and figure out a balance that works for all stakeholders involved. So here's an example of what I mean. This is a segmentation model that was done by Bain, which takes a look at diversity and inclusion and looks at the percentage of people who are driven in their purchase decisions by sustainability objectives. LGBTQ plus people, there's a 78%. It's a very big study that Bain did. Neurodiverse people, Gen Z and millennials, as we usually feel, really big global average, 75%. So there's a huge segment of the society that is part of commitments to DEI and who are amongst those most active stakeholders in the quest for the outcome of a healthy climate. A healthy corporation helps a healthy climate. Now, what do we see, however? In the United States, the pressure has really, really mounted. The SEC, and this is a headline just from, again, a couple of months ago, the director announces the closing of the greenwashing unit, but vows to remain vigilant and poised to reinstate if violations resurge again. I mean, that's really a bogus statement, to be very frank about it. Do you wait for the violations to resurge? And that's one of the differences between the American cultures of regulatory vision and the European culture. Do you wait for the violations to come about, or are you proactive and help to keep a culture and an atmosphere where the violations do not come about? Or they're mitigated in terms of when they come about immediately. This is really a step back. And again, take a look at the BlackRock statement from 4 years before. By no means unrelated is the concern that robust standards exist. We need to have them to mitigate the risk of greenwashing. The risk that either through confusing or outright misleading investment approaches, asset owners cannot make informed choices about the actual sustainability characteristics of their investments. That statement is in direct counter to what the SEC is. So there's been an awful lot of pressure that's been put on it. There's a sense in some parts of the community that all of this has gone too far. But there's a sense in the other part of the community, if we don't go far enough, we will lose the acceleration and the advantage we've gained to date. Okay, so what is also creating this unsettled atmosphere, this sense that on the part of some that we are not able to really resolve this problem in a way that is going to be timely and, if you will, continuous. Well, there's this myth about the sustainability consumer, and this feeds, I think, the backlash that you've seen, the pushbacks that you've seen. Here's number one: most consumers are not committed to sustainable practices. Number two, those committed are young consumers, so there are not enough, or there's not enough money for a critical mass for change. Three, most countries are not concerned unless they are very industrialized. Four, sustainable products are too expensive for most consumers. Now, these are all myths, and I'm going to try to run you through this particular video, which I think is quite interesting, from Bain. Let's see if we can get this up and running for all of you. Alrighty, we will try to share this with you. Hold on one second here. We're trying to get this up and running. Okay, if you let me.
The science and the models are very clear. To get to humanity to meet the Sustainable Development Goals, we need three things. We need new technologies, we need regulation, and we need changes in behaviors. In our conversations, in my conversation with executives, very often consumer behaviors are considered unactionable and fixed. That it's not the case. It's a very actionable levers, and consumers are actually looking towards companies for help.
We embarked on a global sustainability study where we surveyed 23,000 people across 11 countries. We then followed up with one-to-one in-depth interviews to uncover the why behind the what. And then we also embarked on interactive shopping missions where we actually could observe what people did when they shopped. Consumers do have a desire to shop sustainably. 50% of consumers say that sustainability is in their top 4 considerations when they're shopping. However, with misinformation and misconceptions, even with the best intentions, consumers aren't always making the most sustainable choice. There's a myth that consumers who care about sustainability live in developed markets, that they're left-leaning, and that they're young. But through this research, we discovered that that just isn't true. We found that 79% of consumers in fast-growing markets such as China, India, and Indonesia have very high levels of concern for sustainability versus 55% of consumers in developed markets. We found that although there is a perception that sustainability is heavily politicized, that the vast majority of Americans actually do care about the environment. Globally, concerns for sustainability actually span generations with very little difference between older generations and younger generations. There are some countries, India, Japan, and France, where older people actually do care more than younger people.
There are 4 actionable levers for companies and executives to act on the insights of the research. First, strategy. Include consumer behavior change as a variable in your next 3, 5, or 10-year strategy cycle. 2, segmentations. Forget about the average consumers. They are consumers who will always pay for sustainable products. Consumers will never pay. You need to segment your consumer base way better than you do. Third, test and learn. Modern marketing and communication tools allow you to test the right words you use, to test the right explanation you give on your offer, so that you can really adapt your messaging and your product to these various segments. For regulations, you have an indirect influence on regulation, and regulation helps accelerate the right behavioral change amongst consumers.
It's critical for businesses and governments to understand both what motivates people to shop and live sustainably, but also what barriers they face.
The main thing we learn in the research is that consumers want to change behaviors and can change behavior, and that most consumers change behaviors much faster than what executives give them credit for.
So we really hope that this study will fundamentally reshape the way that businesses and governments engage with consumers in the future, and that it's really time to take action now.
Okay. So the price-resistant fallacy. I'm assuming you're still with me, yes? Okay. Take a look at this chart. Very interesting. Price in this price in this situation. Are we okay? Okay, we have somebody who was. Thank you. Yes, very good. Price resistance is a very, very small factor. 85% of the problems are non-price. For example, products not entirely sustainable. Low availability is an issue. Lack of information. If you look at one of the almost on the same percentage level as higher price. Trust. Lack of alternatives. So overwhelmingly, and again, take a look at the numbers. This is a global research study, over 2,000 and follow-ups that they did. So I think it has quite a lot of validity, and is I think a benchmark for all of us to realize price is really a fallback when people just don't want to do it or are not certain as to how they have to now go about repackaging and reconsidering their marketing content. Again, we've got to rethink how we go about doing all of this. So, segmentation modeling is one of the keys here. There's no average consumer. And as the main lead was saying, only the most passionate consumers make sustainability their sole purchasing criteria. By the same token, only those who will never do it. But the overwhelming number will. Most base their choices on a combination of factors, from price to convenience and what have you. So the challenge is to strategically align sustainability with key purchase criteria of the category without forcing trade-offs. So it really means you've got to begin to think differently about how you price and, if you will, how you market. And there has to be an intensive convergence of the two. This is one of the reasons why, for example, we call for more and more in another module, the integration of the various departments, that there be an overarching sustainability vision so that merchandising, product development, and marketing do not have different, if you will, agendas and a different language and a different set of standards. Because then you can't really do the kinds of decoding of the consumer and the conversation that's truly a sustainability conversation. So there's no average consumer. It tells us that we have to design segmentation models, but they have to be based on psychological and behavioral data, social and cultural values, and the others that are listed there. We simply can't look at age, all right, and income. That is the demographic data, because that's just a starting point. And we tend to default to that because that's the kind of data, number one, that's most readily available. Number two, that's least expensive. Number three, that we're most of us accustomed to and comfortable with. But very frankly, that data will not get us to where we need to be in the climate challenge. So we've got to up our game. It's quite simple, and we have to do it as soon as we possibly can. Thank you very much. Okay.
Thank you
So-
very much, Bill. Let's see if anyone has any questions. Feel free to raise your hands.
Any questions? I'm happy to answer them. Oh,
Yes, Lauren.
I have a question. So,
Yes, Lauren. Hi,
thank
Lauren.
you. Hi. Thank you so much for inviting me. And I wanted to ask why you think the some generations or people they may be pulled and say that sustainability is important to them, but then they don't actually follow through. The data doesn't work out that they will actually choose that in the end. Why do you think that that is?
Well, yeah, you raised an important point. It's called the opinion behavior gap. And it's one of the big challenges that we have. We've done a lot of work in this. And what we find is there's the embarrassment factor, which is a good and bad point. Meaning what? It indicates that they know they have to say something that is positive about their commitment because it's an important issue. And they don't want to appear to be negative, yes, and unsupportive. But by the same token, they're either confused. Notice the 85 reasons apart from percent-wise, apart from price, that people don't buy or behave sustainably. So there's a lot of work that we need to do. And I think what we don't do is retool, as I've indicated, our internal organizations and totally rework our marketing. So really, that's my answer, Lauren. Does that make sense to you?
Yes, it does. Thank you.
Absolutely. Anyone else, any questions? I'm happy to field them. If you have anything else afterwards, you all know where I am, and I'm always, quite happy to have any emails that you want to send me or anything else.
If no one has any more questions, I think we can thank you, Bill, for this webinar, and we'll see you at the next one.
Thank you, everybody, and thanks for coming. See you soon.